Congress and the IRS use specialized language to control nonprofits. Understanding some of their jargon is necessary to stay out of trouble and to fill out the IRS forms correctly. Have you ever heard of a disqualified person? Disqualified person is a special term that's used frequently in the tax code and the IRS guidance for nonprofits. A disqualified person is someone who has a lot of power or influence over a nonprofit organization, like a big donor, a board member, an officer, the founder, family members of family members of donors or officers or founders, or businesses that are controlled by one of these people. Because these people can help make important decisions, special rules exist to stop them from using the organization's money or resources for their own benefit, and to make sure they don't have unfair advantages. These rules help protect the nonprofit, making sure it serves the public and not just the people that run it or donate money to it. Okay, the rules of disqualified persons apply to 501c3 organizations, and they apply to private foundations and to public charities. For private foundations, the rules are much stricter than for public charities. If you're a disqualified person with a private foundation, you're usually not allowed to make any deals or financial transactions with the foundation, even if the deal might be fair. Now, the law is very strict because private foundations are often controlled by a small group of people. This makes it easier for somebody to help themselves instead of helping the community. If these strict rules are broken, there's big penalties. Now, for public charities, the rules are still important, but they're not quite as strict as for private foundations. Public charities have to make sure they don't give special treatment or unfair benefits to disqualified persons, but the law thinks it's easier for public charities to make fair decisions because they have more people involved, and so they have more public oversight. If a public charity does give a disqualified person an unfair benefit, they can still be punished, but the rules give them a little more flexibility as long as decisions stay fair and are truly helping the community. The concept of disqualified persons comes from Internal Revenue Code section 4946, and that applies to private foundations. But this concept has also been adapted and applied to public charities, usually under section 4958, and that covers excess benefit transactions. Now let's talk about disqualified persons and public charities, and this would cover the excess benefit transactions rules. Disqualified persons cannot be paid more than is reasonable for the work they perform. So if they're doing $20,000 worth of work, you can't pay them $100,000. And they can't get special deals or perks. Now, if they engage in excess benefit transactions, the penalties called intermediate sanctions can apply, and those penalties can be pretty bad. 25% of the excess benefit up to 200% of the excess benefit if it's not corrected timely. In other words, if the organization doesn't get paid back. So what are some examples of excess benefits? Well, unreasonable compensation that we've already mentioned. If you're selling property, if the organization sells property or leases property to a disqualified person at below market, that would be an excess benefit. Okay, or if the disqualified person sold or leased property to the organization at more than fair market value, that would be an excess benefit. Loans to the disqualified person at a below market rate, that would be an excess benefit. It's usually a good idea not to make loans to any disqualified persons, regardless of what the rate is. And any benefits or perks that are not documented as reasonable compensation might be an excess benefit. Okay, and then of course the overpayment for goods or services could be an excess benefit if those are purchased from the disqualified person. Now, something I want to say about benefits received by a disqualified person and they're not documented as reasonable compensation. These can fall into what's considered an excess benefit an automatic excess benefit transaction. So anytime a disqualified person is being compensated, let's say they're getting the use of a car that's owned by the charity, that needs to be shown as compensation to them. Okay, if they're using it for personal purposes, not for business purposes, of course, but if they're using it for personal purposes, you need to document the value of that benefit, and it either needs to go on their W-2 or a 1099, or it needs to be disclosed on the Form 990 or 990EZ as compensation. And of course, it also should be approved by the board of directors and documented in the meeting minutes. And of course, the person receiving those benefits should not be voting on the amount of the benefits that they're going to receive. Now let's talk about private foundations and taxable expenditures. So what this involves with a private foundation is spending the foundation's money in ways that the IRS doesn't allow. Okay, and what does that mean? Well, supporting a political campaign or influencing legislation. Okay, private foundations can't do that. Paying scholarships or travel grants to individuals without IRS advanced approval, or paying grants out that are used for non-charitable purposes. Okay, these are taxable expenditures, and they incur a penalty tax. Although you can have the tax abated if you can show there was reasonable cause for doing that. The other, which is really worse, is the self-dealing transactions. This is any transaction essentially between the private foundation and a disqualified person. So if you're buying something from a disqualified person or selling it to them, if you're making loans to or from, or if you're renting an office from a disqualified person, basically you should not be conducting any kind of transactions, even if they seem fair. I mean, the IRS is really draconian, or I should say Congress really is really draconian about this. Now, in certain very limited cases, paying compensation to a disqualified person by a private foundation might be allowed. Okay, but it's more complicated than I have time to get into here, and essentially you should just avoid it. So public charities in particular can get ahead of this by having a conflict of interest policy and sticking to it, and having the board involved in all decisions for transactions between disqualified persons and the organization. This is something you really got to watch out for, and I see a lot of it, especially with the private foundations. The self-dealing, taxable expenditures. Oh boy, does that create a mess. So avoid that and educate your board members about these problems.